Welcome to the Four Seasons Podcast, brought to you by B&H Wealth Strategies, serving Northeast Tennessee and Southwest Virginia since 1966. Here, we guide you through the ever-changing seasons of your financial journey, offering insights to help you grow, protect, and enjoy your wealth. Ready to turn your financial dreams into reality? Dare to dream. And now, here's your host, President of B&H Wealth Strategies, Jeff Bingham.
A new year brings new opportunities and sometimes new financial rules that can reshape your investment strategy. Welcome back, everybody. Skip Monty, co-host / producer, back in the studio with the star of the Four Seasons podcast, President of B&H Wealth Strategies, Jeff Bingham. Jeff, how you been this week?
I've been good. How about yourself, Skip?
Doing just fine. Glad it's warmed up a little bit. I had all the snow I can handle, I think, all the storm.
Isn't that the truth? Yeah, winter certainly has been around the Tri-Cities area this particular year, most definitely. So yeah, the warm weather gives at least us a glimpse of spring, and new growth is just around the corner.
Amen, brother. Amen. I'm excited. I'm a spring kind of guy.
Yes, indeed.
So Jeff, to get us started today, why don't you walk us through this question? Are there any changes in the new year to consider for the average portfolio?
That's an ageless and timeless question right there that we get often, and I think I think you always kind of have got to evaluate. I think the first of the year is always a good time to evaluate portfolios and positions and those types of things. So let's kind of lay that out there. That doesn't necessarily mean that just because we're moving into a new year that you necessarily need to do anything. As we try to let's say try to forecast, what 2026 is going to bring with the various, tax implications and benefits of the big beautiful bill, that environment that kind of creates. I think that certainly plays a role in all of these things, and people want to get, kind of very granular, kind of down into that. But I think if you really back it up, what you look at more than anything else when you think about portfolio changes and adjustments, and I think they are warranted, and I'll go through that. But I think, again, you go back to when you think about really making big portfolio changes is more along the lines of what's changed for you. Is the where you are, where you want to go, how you want to get there, have any of those things changed? And that really, is what kind of warrants any major changes. However, with that being said, let's say that's the constant and you built a portfolio to achieve those goals right there. You still make changes, sometimes more dramatic than others, but really subtle changes that are in there. And we've just gone through some. So I think this is a timely, episode to kind of go through. If you look at what we have just gone through and done is adjusted portfolios, tweak, kind of rebalance, made a few minor adjustments, and I'll kind of talk about what those are. But when you look at that, where this rebalancing of a portfolio, kind of these are adjustments that need to be made. And these are just kind of very simple, kind of tried and true disciplines that will work over time, because we've had 3 straight years of very solid growth in the markets, right? Where the US market has been up or over 20% 3 consecutive years, coming off of 22, which was a pretty dismal and down year, but 23, 24, and 25, all very strong performing years in the 20 plus range in return on the S&P 500. And so if you haven't done anything with your portfolio as that's gone through, and you're a 60-40, kind of balanced investors, and when I say 60-40, 60% stocks is kind of the traditional, 40% bonds, fixed income type of asset, kind of the traditional moderate portfolio. If you hadn't done anything or touched that in the last 3 years, what that looks like now is that it's probably closer to 70-30, maybe, maybe even edging up towards, 75% to 25%. So your risk is now out of alignment, right? So you've now got more risk in your portfolio. Yeah, there's some advantages of kind of letting winners run for a while, but has your risk tolerance changed? Again, where you are, how you want to get there, right? Go to that question right there. And that how you want to get there, even though you like the returns on the upside, now your exposure to a movement to the downside is going to be more dramatic, right? Because stocks, are a more volatile asset than bonds are, at least typically, and that's almost, that's true. We'll just say that's a true statement right there. So you adjust simply on a rebalance. If you don't do anything else, what I would encourage listeners out there to do that aren't clients of mine is to look at that and see if that in fact has happened to your portfolio where, you consider yourself a moderate and that moderate is at 60 to 65%, something like that, into stocks of various descriptions, right? US market, international, et cetera, whatever kind of balance you're doing that. But is that all of a sudden crept up to over, 70, 75%, which will put you into a growth investor category out of the moderate. And again, if nothing has changed and your risk tolerance remains the same, you just do that. So you sell high and you kind of buy low, right? You sell some of your winners, you get back to equilibrium in the portfolio, and you buy some things that are undervalued and kind of depressed, and you put your risk back into play right there. So that's one way to make a change in a portfolio as you get into the new year. And and a calendar year is a nice time, to do that, right? You kind of clean house and kind of take inventory of these things on the as the calendar moves from one year to the next. That's kind of what we do. Kind of makes sense to do, but it doesn't mean that you can't do it at different times during the course of the year. Certainly, during reviews with advisors and whatnot. And then you also look at the underlying assets that are in there. You've got exposure into, large, what we call large company U.S. stocks and medium sized companies, small caps. And so you also look at the underlying players that you have in these asset categories, right? You have mutual funds or ETFs, exchange traded funds, or even sometimes individual stocks. And so you want to look at those particular assets and say, are they performing relative to what we benchmark into, whatever the appropriate benchmark would be? Are they performing as we would expect? Are they underperforming? Are they outperforming? Have they changed the way that they're doing things? And so we had, an asset class in our small mid cap category as an example that was underperforming, right? It wasn't giving us the performance on a relative basis to the benchmark that we would expect. So you start, and we've been looking at that. You kind of watch list them over a period of time, and then you take the inventory as we did at the first of the year, and you say, well, can we find an alternative to this fund, let's say, that's in this asset class and make that change? So again, you're not making a risk change, you're making a decision on performance of finding a better player for that position, right? Think about it's kinda like managing a baseball team or something like that. Like my second baseman, is not is just not hitting well, he's not fielding well. Let's go in the market and find one, that fits the bill and the culture of our team better, and so you make a trade for that, let's say, something as simple as that to kinda use an analogy like that. So there's a little bit of it there. Like I said, the rebalancing part though is really the critical part. Very simple to do, and adjustments that are made keeps your risk tolerance intact. And you actually do that too. It doesn't have to be up markets when you do that. Now, as we're talking about coming off of these back to back years, 3 years in a row of upside movement in the market, significant. But also it could be on the downside. I mean, you could have come out of 2022, let's say going into 2023, kind of backtracking to that, to where stocks and bonds both were very poor performers. So you may not have gotten too far out of balance, but if stocks woefully underperformed bonds and bonds did well, as an example, that's not what happened in 2022. Using that as maybe a poor example, but an example. Nonetheless, you would want to rebalance that portfolio and add positions, right, into the stocks to think because they went down further. So you actually want to add market exposure. So that 60-40 allocation now is 55-45. You would want to take 5% out of the fixed income and move it appropriately, back into the stock market, the equity part of the portfolio to get back to that equilibrium. So rebalancing works, on both on the upside, right? On the part that everybody likes, things going up. And it works on the downside as well. What people's instincts are, though, again, this is human behavior where it comes into the investment kind of, investment behavior is is an interesting thing to watch that I've been watching for 35 years. People want to let those winners run. They don't want to sell things that are going up in value. Right? Let's let this thing continue to go, even though I've gotten out of my risk tolerance, right? They want to let that go. And then we have the conversation of why not to do that. Same thing on the downside. On the downside, if the market's, it's going down, it's going down. We're coming out of 2022 as an example. I'm saying, let's rebalance, let's get this back to equilibrium and get, sell some of the fixed income assets off and buy into the stock market. And people's instincts are to, no, I want to get more out of stocks because they're going down, and my fear is they're going to keep going down. So it's, we have the science, if you will, of, or I guess is the right term, of portfolio balance that we've researched, and we know, portfolio theory, and we know all these things that we need to do, but then we have to weigh that, and that's the battle against human, you know, psychology, right? And the preservation and the greed and fear and greed in money management is quite prevalent. And you have to manage those expectations as well as the money itself.
So, are there any, and I know there's been a lot of talk about this in the news, are there any tax related adjustments like contribution limits or bracket changes that people should be aware of?
No, I think, depending on your contribution limits, I'm speaking to that right there with whether it be a Roth IRA or traditional IRA, at under 50 years old, your contribution limits are $7,500, that you could put into an individual retirement account, whether it be a traditional IRA, excuse me, or a Roth, and that's per individual. So a household, a husband and a wife, can contribute $15,000 if they're under 50 and meet some other requirements, but they have that opportunity to do that. Which one they should do is a different conversation, Roth or regular. Um, but also, if you're over 50, you have the catch-up provision, which allows for $8,500 of contribution limits into the individual retirement accounts. And then you have, and I can't articulate these off the top of my head, but you look at your 401k plans or similar versions that you have, through your employer. And what those caps are based on, percentages, and then also kind of, what we call top heavy rules and things like that. So you want to look at those. So there are some things that are in there um, that you want to look at, and I think those are kind of a one size fits one. And maybe, maybe at sometime in the future we might, kind of touch on what were the goodies that I'll use that term, that were in the big beautiful bill that we might, kind of touch on and kind of go through that at some point in time in the future. I'll leave it with this. What you want to be with an investment approach, I think, is everything in life. It requires balance and it requires discipline. And so that's what really is the story that hopefully I conveyed this morning.
Balance and discipline. That applies in life in general, right?
I think it does, and it holds
Absolutely.
true. Yeah, absolutely.
Absolutely.
Amen.
All right. Jeff, thank you again, and we'll see you in the next one.
Thanks, Skip. Have a great
All
day.
right, man. You too. Bye bye.
Thanks for tuning into the Four Seasons podcast, brought to you by B&H Wealth Strategies, where your financial success is our priority. Schedule your free 20-minute consultation today by calling 423-247-1152 or by visiting bhretire.com. Take the first step toward making your financial dreams come true. Until next time, remember, every season is the right season to plan for your future. Securities and registered investment advisory services offered through Silver Oak Securities, Inc., member FINRA SIPC. B&H Wealth Strategies and Silver Oak Securities, Inc. are not affiliated.